Hey, welcome everybody to the Options Trading 101 webinar. Great to see so many people here from all over the place, from Thailand, a lot of Americans, Canadians, a few familiar names as well, which is great to see you guys here. So welcome. Just quickly before we start, I'm just going to do a quick poll. Just interested to see how much experience everyone has with options. Typically today's webinar is going to be geared towards beginners. So some of this will be review if you've had a bit of experience, but if you're a complete beginner, you're going to learn a lot. And even if you've had a little bit of experience trading, there'll probably be a few little tips and things that you might pick up. So, all right, pretty good. So 15% never made a trade, 22% 0 to 6 months, and about 60% 6 months plus. Okay, cool. Thanks everyone for participating in that. Alrighty, there's our results. So just before we start, a quick disclaimer that everything discussed today is for educational purposes only, is general in nature, and does not take into account your personal circumstances. No representation is being made that any portfolio will or is likely to achieve profits or losses similar to those shown. Options are risky. And make sure you check out the disclosure document, characteristics and risks of standardized options, available from optionstradingiq.com/risks. Okay, so some of you know who I am, but for those that don't, just a little bit of background on me. I started trading options in 2004. So that's me, my wife and my daughter Zoe there. That photo, I like this photo, but it was taken probably about 10 years ago. I like it because I look nice and young. I was probably about 30 there. I'm now almost 41. Zoe just turned 13, which is hard to believe. And yeah, it makes me feel quite old, but I've been doing this for a long time. I've been teaching traders since 2010. So done a lot of teaching, courses, webinars, things like that. So been at this a long time, spent thousands of hours researching, just live, eat and breathe this stuff. I've authored 8 books on options, short books on Amazon. Some of you have probably seen them. If not, just reach out to me. I can get you some free copies of those. You know, I'm not one of these guys who worked on a trading desk or anything like that. I'm just like you. I kind of started out as a retail trader, interested in learning more. You know, I first learned about, I remember reading a book about different asset classes when I was about maybe 21, 22. And I always knew you could make money in the markets when they went down, but I didn't really know how to do it. Like I kind of knew you could short sell stocks, but I didn't really know much more about it than that. And then I started reading about options and I'm like, oh my gosh, this is amazing. This is exactly what I've been looking for, and just been hooked ever since. So anyway, a little bit about me. So what are options? So an options contract is a contract between two parties giving the buyer the right, but not the obligation to buy or sell a security at a predetermined price on or before a predetermined date. You're probably pretty aware of that definition, and we're going to get into some more details as we go, and we're going to look at some examples later on in the webinar. So to acquire the right, the taker or the buyer pays a premium to the writer or the seller of the contract. So there's always two sides to the contract. A call option is a contract that gives the holder the right, but not the obligation, to purchase a certain underlying asset at a certain price. A put option gives the holder the right, but not the obligation, to sell a certain asset at a certain price. So that's where we start to learn about making money when stocks go down, is buying put options and bearish option strategies. So why do we use options? Well, there's 4 main purposes. They actually started as a risk management tool. So people, large investment managers, wanted a way to protect their portfolios from a market crash. So that's how they actually started, buying put options. So for a hedging and risk management purpose. And then they've evolved from there, where people are now trading them for leverage, income and speculation. Then you've got income traders who are kind of acting as the insurance company where they're selling that premium. So hedging, leverage, income, and speculation are the four main uses of options. Let's talk about hedging. Let's say an investor has a portfolio of S&P 500 stocks and is concerned about a drop in their value over the next few months. Buying an SPX or even SPY put option would give the investor some downside protection. If the S&P 500 falls, the value of the investor's stock portfolio will drop, but he will have made some profits from the bought put, which will help offset the losses. In terms of leverage, since options cost only a small fraction of the price of the underlying asset, an investor can gain a larger exposure to a certain security by buying put or call options instead of buying the underlying asset directly. This particular feature of options is known as leverage. So you can see a generic example here. ABC Corporation, stocks trading at 60, a 3-month call option is trading at $1. If we were to purchase the shares and the stock goes up to 80, it's a linear relationship. Goes up, we make money, goes down, we make money on a proportional basis. Goes up to 80, we make about $2,000, around 33%. The call option, our losses are capped on the downside. The most we can lose is the premium that we paid, the $100. And we've got unlimited upside potential. And this is where we're seeing that leverage come in. We've made a similar dollar gain, slightly $100 less because of the premium we paid, but we've made $1,900, but we've only spent $100. So that's a huge return. So that's the leverage feature that's available with options. Some of the main features of options. Well, firstly, it has to be on an underlying asset. So that could be SPY or Apple or Google. Lots of different options available on different underlyings. It can be stocks, ETFs, indexes, commodity ETFs, all sorts of different things. Just about anything you can think of trading, you can trade options on. It's going to be either a call or a put. There's a standard contract size of, generally that's going to be 100 in the US. There's an expiration date. There's a strike price, a premium, and it's going to be either an American or a European style option. That doesn't have anything to do with geographic location. It's actually just the style of options. So typically stock options are going to be American, ETF options are going to be American. There's only a few European options, and those are on indexes. So SPX, RUT, NDX, and VIX are some examples. So you could have SPX options, which are European, and you can have SPY options, which are American. So based on more or less the same underlying, but a different style. And the main difference between American and European is European options can't be assigned early, and they're cash settled at expiration. So you don't actually take ownership of the underlying asset with European options. Let's talk about intrinsic and extrinsic value. So intrinsic value is the difference between the strike price of the options and the current price of the underlying asset. It is the portion of an option's price that is not lost due to the passage of time. The time value or extrinsic piece of an option is the amount of option premium that is not made up of intrinsic value. So time value is calculated as the option price minus the intrinsic value. We'll look at some examples in a minute. We're going to look at some examples right now, in fact. Apple was trading at 147 on July 8th. An August 19th, $140 call option, it should be, is trading for $11. How much is the intrinsic and extrinsic value? Who knows? Let's start with the intrinsic value. So the stock's at 147, the call option is at 140. Anyone know the answer? Drop it in the chat. Yep, exactly. John's got it. First one in. Well done. $7 of intrinsic value. So how much is the extrinsic value? How much is the time value? It's going to be the difference, right? 4, exactly. So $7 intrinsic, $4 of extrinsic or time value. Volatility is the single most important concept to understand when it comes to options. Stocks with high volatility will have high option prices, and stocks with low volatility will have low prices. So I could probably spend a week talking about volatility, but it's a really important concept that you should need to spend a bit of time understanding. We're going to look at some examples here. So this was from a while ago, Roku and PG, comparing two different stocks. They were both trading around the same price, roughly around 120, and the expiration was around 31 days. Now, Roku is a much higher volatility stock than PG. It moves a lot more than PG does. PG is very low beta, low volatility. So if we look at 120 strike call option, and at the money call option was trading at about 11.25. That's the option price there, 11.25. The PG call option with the same strike price, same expiration, is only trading at $2.87, because the expectation is that PG is not going to move much over the next 30 days. It's only going to move a couple of dollars either way. Whereas Roku could move $10, $20 over the next month. Doesn't mean it's better to sell Roku options because they're higher priced. And we'll get to implied volatility percentile and rank in a minute. It just means that the options are more expensive because the stock's expected to move a lot more. Hopefully that makes sense. So an important concept to understand is IV percentile. So previously we were comparing the IV of two different stocks. Typically what you want to do is look at that one particular stock and look at the IV of that stock compared to past history. So IV percentile indicates the percentages of days with implied volatility closing below the current implied volatility. So let's say we have a IV percentile of 100%. That means that for that particular stock, that's the highest level of volatility we've seen in the last 12 months. If we have an IV percentile of 0, that means that's the lowest IV reading for that stock that we've seen in the last 12 months. So typically with options, what you want to be doing is you want to be selling options on stocks with a high IV percentile, and you want to be buying options on a stock with a low IV percentile. So we're buying those cheap options, we're selling the expensive options. And that's looking at the stock itself. We're not talking about that Roku PG example where we're selling Roku options just because they're expensive and we're buying PG options because they're cheap. We're looking at, we could actually have in that scenario, those Roku options could have potentially had an IV percentile of 0, and the PG options could have had an IV percentile of 100. So in actual fact, it would be better to sell options on PG than it would on Roku. If that has gone over your head a little bit, just shoot me an email afterwards and we can go through that a bit more detail. So here's an example from a year or so ago. This was MasterCard. So the gray line is kind of the stock price and with the index on the left, and the white line is the implied volatility over 1 year with the percentile or percentage on the right. So at this point in time, is MasterCard low IV or high IV? And what do you think the IV percentile might be? Drop it in the chat, let me know. Yeah, so it's got low implied volatility compared to past history and a low IV percentile, probably around 0 because it's the lowest reading we've seen in 12 months. Another phenomenon we see with implied volatility is around earnings. Now, I don't know the exact dates, but just looking at the chart here, I'm going to guess this big drop here in IV percentile probably happened after earnings. So there's a big uncertain event on the horizon, which is that earnings announcement. Implied volatility kind of rises up into that uncertain event. Once the event becomes known, IV drops. That's known as IV crush. Go forward about 3 months, this was probably another earnings one here, and then maybe again here, and probably here. So you can see them, usually there's about 4 per year, and you can see that IV crush happening. Some stocks it happens more than others, but that's another method of trading as well, trading that IV crush over earnings. All right, here's another example on American Express. So current reading's about 37.7% implied volatility. And that's probably a fairly high reading. It's not 100%. It's not the highest reading we've seen in the last 12 months. That was back here when it got to about 49%. But it's certainly on the higher end of the range. The majority of the readings we've seen in the last 12 months have been below this level. Hopefully that makes sense. Any questions, let me know. Okay, next important concept to be aware of is open interest and volume. So volume and open interest are related, but also decidedly different. Volume is the number of contracts traded during the day's session, and that balance is wiped clean every day. Open interest, on the other hand, is a tally of the total number of option contracts open and active at each strike. So, a couple of examples I like to use. When anyone's starting trading options, you want to stick with underlyings that have really good open interest and volume. Reason being, it's going to be easier to get filled on trades, and the bid-ask spread is going to be a bit lower. It's going to be very tight. So this is the example I like to give. IYT, it's a transportation ETF, pretty popular ETF, but it's not very popular in terms of options. You can see here on this particular day, only 1 contract traded in the calls and very little open interest. Same with the puts, only 2 contracts traded across the whole strikes here for this particular day and very low open interest. So if I wanted to trade, let's say I wanted to buy this 265 call option, there's quite a big spread there. So it's unlikely I'm going to get filled at a good price. And by a good price, I mean somewhere near the midpoint between these two. I'm probably going to have to overpay a little bit to get into it. And I'm also going to be the only person with open interest in that contract. So if I then need to sell out of that contract, the market makers know I'm the only one with a position in that contract. It's going to be very, very hard to get a good price. They're going to take advantage of me on that when I'm trying to exit that trade. So I want to try and avoid anything with low volume and low open interest. Typically with open interest, you want to see at least 100 contracts of open interest, preferably about 500. Now we look at SPY. SPY is probably the most highly traded instrument in the US, both as an ETF and for options. So comparing to that last example, IYT, we've got huge volume here in each strike, 6,000 here. And we've got massive open interest, 33,000, 13,000, 11,000, same in the puts. Very, very easy to get filled on these options. So this is a great place to start with SPY. You know, others are sort of Apple, any of the big names really are quite good with volume and open interest. And you can do scans as well to scan for the most active stocks for options trading. Typically the list is pretty similar each day. The top 10, it's, you know, your Apple, SPY, Microsoft, that sort of stuff. And if we also look at the spread, very tight spreads. We've got 5-cent spread here, 4-cent spread here, 4-cent spread. Very, very easy to get filled at the midpoint. Just a quick question here on IV. So Ganesh says, does IV change for each expiration period in your graph? Is it the average IV? So yeah, we might get to that later, but if we go back to IV percentile, this is the implied volatility of the stock. Where it gets a bit tricky is you also have implied volatility for every single option contract available, and that can be different, as you said, across expirations. It can be different across strikes, and that's called volatility skew. So you can have vertical skew, which is differences in implied volatility up and down the option chain within the 1 month. You can also have differences in IV across different expirations, which would be called horizontal skew. The one we're looking at here is just the implied volatility of the stock generally. And that's typically what you want to look at to start with, and then you can start drilling down into the IV of the underlying option chains. But this is the place where you would start. All right. So bid-ask spreads, as I said, when you're trading options, you can receive a price close to the midpoint of the spread, but sometimes the market makers will make you pay a little bit extra or receive a little bit less if you're selling those options. So as we saw before, the spread here on IYT at the money call options, 90-cent spread. Whereas over here, it's a 5-cent spread. If we take that in terms of percentage, let's say 90 cents over $11 is about 8%. So that's a big spread. You're potentially quite far behind the 8 ball, you know, when you first get into the trade because you've received a bad price. The other thing to remember is you are going to suffer that, we call it slippage, and not getting a good price on a trade entry. You're going to suffer that on entry anytime you adjust the trade and also when you close. So that's why the bid-ask spread is so important. Whereas SPY, we've got 5-cent spread over 747 is less than 1%, 0.66% compared to 8% spread. So very, very important. Even as an experienced trader, I'm avoiding anything with a big spread and that's thinly traded. And certainly when you're starting out, you want to stick with the highly liquid stuff. All right, option Greeks, another topic I could probably spend a week on, but let's go through some basics. So delta is the option sensitivity to changes in the underlying stock price. It measures the expected price change of the option given a $1 change in the underlying. Gamma is probably not as important as some of the other Greeks, but it is a metric that it's the sensitivity of the delta to changes in price of the underlying. So gamma measures the change in delta for every $1 change in the underlying. When it comes to Greeks, this is probably the one I'd worry about the least or start to understand last. Delta, Vega, Theta, those are probably the three big ones. So Vega is the option sensitivity to changes in implied volatility. A rise in implied volatility is a rise in option premiums, and so will increase the value of long calls and long puts. Vega also increases with each expiration further out in time. We'll look at some examples in a minute. Theta, another very important Greek, particularly for option sellers, refers to the rate of decline in the value of an option due to the passage of time. It can also be referred to as the time decay of an option. So some of you may have seen this image before or one similar. Options are a decaying asset. They lose value with each day that passes, assuming everything else stays the same. Time decay is pretty slow to start out with, and it gets exponential as we get closer to expiry. And in that last week of expiration, the time decay is the most severe. Now, that doesn't necessarily mean that we just want to sell options here in the last week. Yes, you're going to get a lot of time decay, but with options, everything's a trade-off. If you're getting a lot of time decay, you've got risk elsewhere. And the risk is that gamma risk, which is basically price risk. So yes, you're getting a lot of time decay here if you sell these options, but if the stock makes a big move, that's going to be really bad as well. A story I like to tell is that, I've received many emails over the years from people when it comes to weekly options, and it'll be pretty much the same each time. It'd be like, oh, Gav, I was trading these weekly options. It was going great. I had, 10 winning weeks in a row, and then I had one losing week and it just wiped everything out and then some, and I've had that email so many times, and I have a love-hate relationship with weeklies. I typically don't trade them. They don't really fit my risk profile. And It's quite difficult with the time difference being in Australia. They require a lot of attention. You need to watch them pretty closely, which is something I can't really do. But they are good. They are good in terms of the time decay. You can get some good profits in a short space of time, but they are risky as well. You know, if you think about the first thing you learn in any finance class, right, is if there's a potential high return, it has to come with high risk. There's no high return, low risk strategy. You know, there's high risk, high return strategies. There's low risk, low return strategies. They're kind of interrelated. So particularly for beginners, you know, I would probably avoid those weekly options unless you really understand them and you understand the risks and you understand the benefits and the potential downside as well. Typically, I like to be anywhere from sort of 30 to 60, 90, even 120 days out on the curve. They move a bit slower. You have a bit more time to react. You have a bit more time to adjust them. Whereas, you know, these short-term options, if the stock makes even just a small move, sometimes the trade can be under pressure. Whereas if we're further out in time, you know, the stock makes a small move and nothing much really happens. You can leave the trade sitting there for a bit longer. So that's sort of the one thing I would say about time decay and weekly options. All right, so that's a little bit of theory. So let's go now and look at some examples. We're going to look at covered calls, cash secured puts, buying calls, vertical spreads, and iron condors. All right, so I'm going to go into my broker account here. This is Interactive Brokers Risk Navigator, which is a really good piece of software. Most brokers will have similar analytical tools. Think or Swim is also another good broker. There's probably not too many others. Those are kind of the top two. A lot of people use Tastyworks. They are good for basic strategies, but not very good for more advanced stuff like spread trading or advanced spreads, broken wing butterflies, things like that. You can't really do those on Tastyworks. I think TradeStation's okay, and maybe Schwab is okay as well, and maybe E-Trade, but those are kind of what I would call second tier. They're not quite as good as Interactive Brokers and Think or Swim. In any case, if you don't have Interactive Brokers, that's okay. Hopefully you can follow along. But what we're going to look at here is a covered call to start with. We're going to look at Wells Fargo. And I haven't chosen this stock for any particular reason other than it's not too expensive. So, you know, it's very hard to do a covered call trade on Google that's trading at 2,000 or whatever, right? Because you need $20,000 to buy 100 shares. Whereas a stock like Wells Fargo trading at 38, we only need 3,865 to buy 100 shares, which is, you know, still a lot of money. So covered calls aren't for everybody, but it's a good example to look at. So we see if we buy 100 shares of the stock, we have a linear relationship. Stock goes up, we make money. Stock goes down, we lose money. Thanks, Bruce. Yeah, I guess the Amazon did the stock split recently. I guess Google has now as well, right? Good point. Okay, so that's a long stock position. Now, if we come in and we sell a call option, it changes the risk graph. We call this an option payoff or a risk graph. The blue line here is what we call the expiration line. So this is the profit and loss at expiration. We can see the maximum profit's about $280. Hopefully you can all see that okay. The maximum loss is still pretty similar. We take the stock price 3,865 minus the premium received, and that's our max loss. Now, the idea with the trade is we want it to trade up to around 40 or above. If it goes up a long way, we're only going to achieve this maximum possible profit. We've missed out on some profit, but the idea is with the trade is we're trying to generate a bit of extra income. Typically, I'm going to do a covered call trade on a stock that I'm willing to hold for 10 years, 10, 15 years, right? I'm going to be sitting there collecting the dividend. If the stock rallies up a little bit, I might sell a call option to try to generate a bit more income from that position. So we're going to collect any dividends from the stock, and we're also going to receive $130 roughly in option premium for selling this call option. If Wells Fargo stays below $40, the call option expires worthless. We can repeat the process. We can sell another call option for September. If it goes up above 40, the shares get called away. The shares get taken out of our account. The option gets taken out of our account. We're left with a nothing position, and we've sold the stock at 40. We've received that maximum gain of about $280 plus any dividends. Now, when it comes to covered calls, I have a little calculator. Some of you may have this already. If you don't, I'll send it around with the replay. Let's make this a bit bigger. So it's just the cells in green that you need to update. Everything else will calculate for you. So the expiration date is August 19th. The stock price is $38.65. Our strike price is 40. And let's say we get $1.30 in premium. So this is just a nice little way to analyze the trade. Gives us our percentage return if the call option expires worthless, which is about 3.5% in 35 days, which works out to be about 36% annualized. If the stock goes above 40 and gets called away, our return would be 7% in 35 days, which is about 74% annualized. Now, I've got another example here. That's a short-term option, lots of time decay. So theta is 3. Means that option is going to decay by about $3 per day. If instead we went with a longer term call option, which is a totally valid strategy as well, I'm going to change the expiration date here to December. We've got a higher return potential because we're generating a bit more option premium. It's just going to take us a bit longer to get that return. We're going to have to wait till December, and our time decay is lower at only $1 per day. So let's compare the two. Our expiration date, December 16th, stock price $38.65, strike price is still 40, but we're receiving $3.20 in premium. Now that's still a pretty nice return. 9% return in 154 days, which is still about 21% annualized. We also have a bigger percentage decline to our break-even price because we've received more premium. So when it comes to covered calls, it's all about finding a balance. Short term is really good, really high potential returns, but low actual premium that you're receiving. Longer term, you can get more premium, but you have to wait a bit longer, which means the annualized return is lower. The other thing I always look at with any option strategy, we can add a custom date here, and I add today's date. So that purple line is what we call a T+0 line. So that's how does the trade look as of today? So if the stock goes up, we're making money. If it goes down, we're losing money. And then slowly, as we get towards expiration, this purple line here is going to move up towards the blue line. And you can see that here. If we change that date to just before expiration, you can see that purple line's moved all the way up there. So any option trade that I'm looking at, I'm always looking at the expiration line and also the T+0 line. All right, so that's a covered call. A lot of people will start out with covered calls because they're familiar with stock ownership. It's very easy to just sell that call option against the shares that you own. Another strategy that I really like is called a cash secured put. Very similar payoff graph, just a slightly lower return, and we've got a much lower break-even price. So instead of doing a covered call, what we're doing is selling a put option. Here we're selling a put at $37.50. What's going to happen with this trade? If the stock goes below 37.50 at expiration, we're going to get assigned, which means we're going to have to buy 100 shares at 37.50. But we've also received $1.60 in premium. So our break-even price is something like 37.10. Is that right? Let's have a look. I always plug this into the calculator just in case my brain's not working properly. So August 19th is our expiration, just on the short puts tab now. Strike price is 37.5, premium is 1.6. Our break-even price, sorry, is the strike price less the option price. Of course, my brain was not working properly. So our break-even price is 35.90. It's not the stock price minus the premium, it's the strike price minus the premium. So in this example, it's a different style of trading. We're getting a lower dollar return. We're still getting a pretty nice return in 35 days and a pretty nice annual return. We've got a much bigger margin for error on the downside, a much bigger decrease to our break-even price. Similar shaped payoff graph, but our strike price is below the stock price and our break-even price is lower. So that's a really nice way that I use to take ownership of a stock that I might want to buy. I might say, right, I'm willing to buy Wells Fargo at 37.50. If it stays above 37.50, I'm happy. Put expires worthless. I keep the premium. I move on to the next opportunity. I've made my 4% return. If the stock drops, I'm still reasonably happy because I'm taking ownership of a stock that I want to hold for the long term. I'm collecting those dividends and I can sell covered calls against that position and keep generating that income. So you can turn that into what's called the wheel trade. Some of you may have heard of the wheel trade, where you're kind of selling puts, and then when you take ownership, you sell covered calls against it and can kind of continue that process, sell more puts if you want to buy more shares. So that's covered calls and cash secured puts. Any questions on either of those? All right, all good. If there's other questions you think of afterwards, you can feel free to email me later on. Next example we're going to look at, let's have a look. I was going to use that for a cash secured put. SPY, I think. All right, so as I said, SPY, the most liquid instrument. Let's say we're concerned about a drop in the market and we want to hedge our portfolio. Remember how we hedge a portfolio? We can buy a put option. So let's say SPY is trading at 378. We want to protect for a drop below 370. We could buy that put option. So we're basically doing the opposite of what we just did with Wells Fargo, where we sold the put option. Now we're buying the put option on SPY. We're going to make money as the stock drops. We're going to lose a bit of money if the stock stays flat or rallies. So the good thing here is our risk is limited. The most we can lose is the premium we pay, which is about $8.25, and our potential gains are unlimited. Notice how we've basically just flipped the risk graph upside down. The bad thing is our break even is below the strike, because we've got to take the strike price less the premium we pay to get to our break even price. Now we might make a little bit of money if the stock drops to say 372 on day one. We might make a little bit of money, but if it gets to 372 on expiration day, we're going to have actually lost money, and we're losing money each day through time decay. So it's not an income strategy. The next thing you can do to cut the risk a little bit, let's say you don't want to spend $800 on protection, you can turn it into a spread. So you buy this one and then you sell this one. And that actually turns it into a bear put spread, where we're buying and selling caps the total potential gain, but also massively reduces our risk, our cost of the trade. And because that's such a low cost now, we could potentially trade a few of those. We could maybe do 5 of them to give ourselves a bit of protection. So that's a vertical spread. The other thing some traders will like to do is a put credit spread. So rather than doing a cash secured put, where we're selling options, we've got massive risk on the downside, we turn it into a spread where we buy that protection. Now all of a sudden our maximum risk is capped. And we've reduced our profit potential a little bit, but we've reduced our risk as well. So typically what I like to do, that's a little bit close for me. If I'm bullish, neutral to bullish on the market, I don't think it's going to drop by too much. I usually go to about the 15 delta. And that's one of my favorite trades, the 15 delta put spread. So here's our delta column, roughly 15 delta. I'll go with the 350 because there's more open interest, although that doesn't really matter too much with SPY. Usually about 5 points wide. So I might, let's just say 2 contracts, 2 and 2. That's a pretty standard trade for me, where generating about $150 in premium, 850 at risk. So 150 over 850 is about a 17.5% return. And we've got a pretty big margin for error on the downside. Stock just, or the ETF just has to stay above 350 and we can generate that return. A couple of questions have just come in. So this is regarding the cash secured put. This one. What do you do when an underlying goes below your purchase price? Would you continue to sell covered calls? And if so, what delta and how far out? Really depends on the scenario, but it depends how far it's dropped. A lot of times if, say, this particular stock dropped all the way down to 30, I probably wouldn't sell calls against it. I'd wait for the stock to recover back up towards my break-even price, my purchase price, and then I'd start to sell calls slightly out of the money. If it comes back down slightly just below 37.50 and I get assigned here, I'd probably sell those calls up at about 40. Usually about the sort of 25 delta for the selling the calls, but it really depends. If I'm more neutral on the trade, I might sell right at the money, sort of a 50 delta towards a 40 delta. Yeah, it really depends on my outlook on the stock at that particular time. Don't really have any hard and fast rules for that. Yeah, you can do a stock repair strategy as well, probably a bit beyond the scope of today's class, but yeah, that's something that you could look at as well. Ganesh says, sometimes the contract value goes down even though the stock price is up. What contributes to this and what groups to watch out for? Contract value goes down even though the stock price goes up. So maybe you're talking about a long call option there. So the most likely reason for that is a drop in volatility. So if you buy a call option, and let's say the company has earnings, so there's that big IV crush, the stock might go up, but the rise in the stock price has been offset by the drop in volatility. So the option actually loses money, that call option, even though the stock's gone up. So yes, that can happen. Vol crush, exactly, yeah. And time decay. So I think I was going to use the Qs as an example. Let's say I buy a call option on the NASDAQ. The stock could go up. Let's change our T plus 0 date to T plus 14. So just for me, it's trade date plus 14 days. The stock might have gone up to 290, but I've lost money because of time decay. The most likely explanation is the vol drop, the change in volatility, but it could also be some time decay as well if the move happens, but it doesn't happen quick enough. Another question here for the cash secured put, when the underlying price goes below your strike, do you get assigned or roll it out? Again, it depends. If it's a stock that I'm happy to own for the next 10, 15 years, I'll take assignment, I'll collect the dividend, I'll hold that, I'll either wait for it to recover and then start selling covered calls. If it's a stock where it was a bit more of a trade, maybe my opinion of the stock has changed, I don't really want to take ownership of it, I'll close it out before I get assigned and roll it out if I want to keep that exposure, but I don't necessarily want to take ownership. So yeah, that's something that I'll do occasionally as well. When it comes to assignment, if we go back to our Wells Fargo example, the assignment can technically happen at any time. It's only ever going to happen when the stock goes below the strike price. No one's going to assign a put at 37.50 when it's trading there. It's only going to happen when it goes below. Typically, it's going to happen when you get close to expiration and when there's very little time value left. But technically, it can happen at any time. Good questions, though. Alrighty. So the Qs, that's our long call. Nice strategy if you're really bullish. This is trading with leverage. We can make a big return on a small amount of capital if we get it right, if the market goes up. Another sort of lower risk way to trade it is via a spread. So we buy that one and we sell further out of the money. We turn it into a spread, risking 750 to potentially make 1750. We can also do a credit spread. So if we're more neutral to bearish on tech, we want to be an income trader rather than sort of a directional trader. Again, we can go out, typically for me, about a 15 delta, but you can go sort of anywhere 15, 20 delta is okay. I might sell that one and buy that one. I would receive about $170 in premium for making that trade. My maximum risk is about 830, and my break-even price is up around 310. So that's kind of a neutral to bearish trade. 15 delta is the delta of the strike. So the further out of the money you go, the lower the delta becomes. You can use delta as a rough probability of how likely it is to become in the money or be assigned. So 15 delta has a roughly 15% chance of ending in the money. So it's 0.15, but we just say 15 delta for short. Or actually, I was looking at selling the 20 delta in this example. Then one of my other favorite strategies is the iron condor, where we sell the bear call spread, and then we also sell a bull put spread to create a neutral income-based trade. I'll go with around that 20 delta again. So about there. Keep them the same width. So now we've got more of a neutral trade. I'm going to reset back to 2 plus 0. And there we go. So now we just want the NASDAQ to sort of stay in this range. And we've got the chance to make 350 with 650 total risk. So that's one of my other favorite strategies as well. What strategies am I using in this market? Yeah, typically I'm liking iron condors, doing a lot of diagonal spreads as well, which are a bit more advanced. But yeah, iron condors and vertical spreads are kind of my two major strategies, and cash secured puts. But trading a bit less of them at the moment, given that we've been in a bearish market. Do I use the iron condor for non-trending markets? Yeah, so ideal scenario is if you've got a stock or an index you think is going to go sideways for a few weeks, that's exactly what you want to look for. And then when the market starts to trend again, you want to be looking at other strategies. All right, any other questions? What indicators do you use to determine if the market's going sideways? So a lot of price action. So candlestick patterns and chart patterns. Probably the main thing, yeah. And then there's other indicators like Bollinger Bands and things like that. When, you know, one of my favorite things is where you have a period of expansion where the Bollinger Bands get really, really wide. Usually what follows that is a period of contraction where the market will start to settle down a bit. And then when you have a period where the Bollinger Bands get really, really tight, you know, the stock's trading in a very narrow range. Usually following that period, you start to get a breakout. So that's one thing that I would look for. Do curves factor into commission? Do the curves factor in commissions? These ones do not, no. When you talk about the profit and loss graph, so no, doesn't factor in commissions. Commissions are pretty low these days, usually about $1 per contract, and some even have 0 commissions these days, some brokers. What are the adjustments for iron condors? So yeah, another one could probably spend a week talking about iron condor adjustments, bit beyond the scope of today's class, but I can, if you send me an email, I can point you in the direction of some info on adjusting condors. Sensibly, if you wish to avoid assignment, how close to expiry should you leave doing it? As I said, assignment can happen anytime, but let's try and find an example. Not this one, but let's say Wells Fargo, let's say we'd sold a put and it's now in the money. So let's say we'd sold the $40 put, 40 strike put, and it's in the money. One thing I look at is how much time premium is left. So if the strike price is 40, the option price is 282, and that's the difference. The stock is at 36. There's actually still $1.50 of time premium left in there, which is quite a lot. So that one's unlikely to get assigned early. It's hard to give you a general rule, but you know, typically the assignment's going to be more likely in that last 7 to 10 days. Maybe earlier if it's deep in the money, it could happen earlier. So let's say for whatever reason we had sold a put up here at 50. You know, that could potentially get assigned earlier than that last week. That key factor is just looking at how much time value is left. When there's a fair bit of time value left, it's unlikely to get assigned. What is your return on investment using these strategies in this market? It's, yeah, different for everybody. It depends on the success rate, depends on the trade management. As I say to people, getting into a trade is the easy part. It's what comes next that's hard. It's the management of the trade, so that's going to vary. Thomas says, if your credit spread starts losing money, do you close it, roll it, or try to turn it into a butterfly? Yeah, again, depends on the scenario. I have certain rules around credit spreads and exposure levels, and when it gets to a certain point, whether I adjust, roll, or close, and I kind of evaluate that at the time. But I have what's called a decision point. So let's say you're asking about vertical spreads. So let's say I have this particular credit spread. I'm going to set what I call a decision point, and I never let the stock get through the short strike. All right, that's rule number one. But I'm usually going to come in a little bit from the short strike, and I'm going to set a decision point. Usually with a spread like this, a 20 delta spread, I'm generating about $170. Kind of want to follow that T+0 line to where it's about $170 loss, and somewhere around there is going to be my decision point. So let's say 300. So I'll set a price alert. If the Qs hit 300, I'm going to look at the trade, I'm going to look at the chart, and that's when I'll decide my opinion's changed. The market's looking bullish. I'm going to get out of this trade rather than adjusting it. Or, if it gets to this point and the market, I think it's going to roll over and go back down, I might adjust it or hedge it. ACAD was well out of the money, 1951, and I was assigned on 16 put after trading was halted. Yeah, so some of that thinly traded stuff could be a bit weird like that, for sure. How many times leverage are you trading now? Has this changed due to sentiment in the market? I don't really trade with leverage at all. Don't recommend that either. And yeah, when the market goes a bit crazy, like it did a few months ago, I cut back on delta neutral trades in particular. Yeah.